Good afternoon, Insignio family. Today's February 12th. We have two very special guests with us today. We've got Jeremy Schwartz and Jim Bianco. Welcome to the show, guys.
Thanks for having us.
Absolutely. So, just by way of introduction, for anybody that has been living under a rock for the last many years, Jeremy Schwartz is the Global Chief Investment Officer at Wisdom Tree. He's worked with Professor Jeremy Siegel and is a co-author of the 6th edition of Stocks for the Long Run. And Jim Bianco he's been president and macro strategist of Bianco Research since 1990. He's held roles at places like UBS and other major firms on Wall Street. And with that said, we're talking about Wisdom Tree with some of the solutions that they have. And we've got a lot to cover for U.S. economy. So, gentlemen, let's start off with the news from this morning and how U.S. inflation is shaping up.
I guess I'll start. The data came in much stronger than expected. 0.5 of a rise in the headline number, 0.4 of a rise in the core number, and it was met as a bit of a disappointment on Wall Street. The hope was that we would continue to see declining inflation to return to somewhere near 2%. But at least as the statistics that are coming out, the core inflation rate, which is less food and energy, because a lot of times those are more driven by supply and demand than inflation, is stalling out at around 3%. In fact, it actually upticked to 3.3%. And this is the 44th month in a row that it's been above 3%. So there's a little bit of impatience kind of seeping in on Wall Street. When are we going to continue to see these inflation data continue to decline towards the Fed's ultimate target of 2%?
Mm-hmm. Okay, and so we see the 10-year now at 4.65. At what level do you think that equity markets start to really get spooked?
Well, this is one of the key risks we've thought for the market, was that if the 10-year would rise, call it 5.25 or higher, that could definitely be one of the things that triggers a bit of a correction. And you saw the market sell off a bit right on the news, and with the 10-year screaming 10 basis points higher. Now you could argue that the Fed is sort of yesterday's story. You had Powell testifying the last 2 days. And in many ways, the Fed may just be on pause all year. The market's certainly pricing out any Fed cuts. There is a sense on the inflation, what are the real drivers? I do a piece every inflation day. We did it out this morning saying, shelter is a key driver. If you plug in some things from Zillow and Apartment List, you take an average of those two. The official shelter numbers are like 4.4 for the last 12 months. Apartment List is negative, and Zillow is more like 3%. So our average is like 1.3. When I plug that in, I get 2% for core and headline. Very interesting, right on the Fed's target. Now, you can say, there's more things than just the shelter that has some issues with measurement. But the path is, I think that shelter number will come down. It's 1/3 of headline CPI and 40% of core CPI. So that will give the Fed some cooling relief throughout the year, that inflation will come down towards that number. Sort of the official shelter number will come towards our real-time number, is my view. And but the 10-year going higher is the risk, and that's what happened today. And I think that's the thing that the equity investors have to confront.
Indeed. So since the Fed is yesterday's story, we'll do one more little piece on signaling theory. And Jim, to your point about having to have a unanimous decision and maybe a better way to read it. What were your thoughts there?
Yeah, so the Federal Reserve, only has a few ways that they can communicate their policy to everybody. They do technically have 12 voters, but the chairman, and not just Chairman Powell, but even dating all the way back to Greenspan in the 1990s, they have this belief that they need to have like a 12-0 or 11-1 vote. And if they were to have that, they think that puts a stamp of, further credibility on Fed policy. But they're the only central bank that does it this way. The rest of them let those voters vote independently. if the Fed was to be cutting rates or holding rates and they were to get an 8-4 or 7-5 vote, even though they'd still get the same policy, there would be a strong signaling there that they're getting close to moving, or they're very consistent with their view. That's important now, because what is apparent from listening to speeches of Fed governors and everything, there's not a wide agreement in that room as to what they should be doing. But by having a 12-0 or 11-1 vote, they portray it as if there's a wide agreement in the room. And that's why the market gets sometimes locked into this idea, well, the Fed's going to go this way. And then you get some data that disappoints or goes the other way, and you have these violent reactions in markets. If the market thought it was a 60-40 or 55-45 decision, and then you were to get a number that disappoints, we were almost there anyway, so it wouldn't be nearly as a big a deal.
Right. Let's go to outlook for 2025. We heard the slogan 456, which is cash, fixed income, equity kind of expected returns. Let's dig into that a little bit.
I'll start and I'll go through the 4-5, and Jeremy could go through this 6-ish or so. I think what people need to look at is if the Fed is on hold right now, and it looks like if you look at the Fed fund futures market, that it's not pricing in the first cut now until September. It's priced it all the way out there, that you're probably going to see the cash rates, money market funds, stick somewhere around 4%. 5 is the bond market. The yield on the Bloomberg Aggregate Index, which is one of the broad measures of the bond market, is just under 5%. It's like 4.95 or thereabouts. Let's just call it 5% for discussion purposes. I think over the next year or two, you're probably going to get the coupon in the bond market, maybe a little bit more if the market rallies, a little bit less if interest rates go up, but it's looking like it's more like a 5% market. So 4% on cash and 5% on bonds. And the question is, where does stocks fit into that equation? I'll let Jeremy answer that question.
Yeah, I mean, I think the way I've worked with Dr. Siegel, as you said, Alejandro, for the last 20 plus years. He often looks at forward PE indicators as a real return indicator. You know, his long-term data on stocks for long run showed 200 years of data, stocks did 6.9% after inflation. We don't think stocks can do that again. I mean, the average P ratio across that hundreds of years of data was 15. You know, 1/15 gets you that 6.5 to 7%. We now have an average P ratio of 23. So at 23 forward P, you're talking like 4.5% earnings yield. Now, part of that is very biased by 7 stocks that have a 32 PE. The rest of the market, the S&P 493, is really close below 20, more like 19. They have like a 5% earnings yield. But you don't have to just buy the market. You can look at many parts of the market that are 13, 14, all small caps. If you look at small caps with any fundamental discipline, we have 3 different small cap strategies. All 3 of them are 13 and 14 PE. One of my favorite strategies is a value fund that focuses on dividends and buybacks. The average buyback yield is 5%. The dividend yield is almost 2%. So you get a 7% dividend buyback yield. That fund, I think, can do the 7% that Siegel's data said over the long run. But you know, for the broad market as a whole, that fund that had 7% buyback and dividends together might do more with inflation. You know, might do closer to 9 to 10. But the market as a whole might just do 6. If you add 2% inflation to the 4.5% earnings yield, you're talking 6.5 to 7. So the market as a whole is going to be weighed down, I think, by the valuations being higher than normal. Earnings expectations were high for this year. They were thinking 16 to 17% for this year. And last 2 years, which were good years for earnings growth, were only 8 to 9%. So can really earnings deliver that much more after 2 pretty good years? It seems tough. And then you got the rising bond yields that Jim's been talking about. If you get above 5, that's the other valuation pressure. So long-term, 6.5 to 7, but you may have some challenges in the interim.
And what you just described is an ETF. Is that DGRW?
So DGRW is a flagship core holding that slightly tweaks the S&P towards dividends and quality stocks. That's more like a 20 PE today. and it has some good profitability screens, big earning screens. The 7 shareholder yield is a value fund called WTV that focuses on high dividend buybacks. It's more active. So any place that has restrictions on active management, it is traditionally an active fund. But it is one of the more interesting value strategies today.
Okay, so last year, 30% of the managers in the US outperformed, so that left 70% underperforming the benchmark. We look at corporate spreads at multi-decade tights. Why even bother with traditional fixed income when we've got private credit?
You know, that's a good question, but private credit is just one aspect of the fixed income market. It is really more of an arbitrage than anything else, because the private credit is a loan, just not from a bank. And because they're not from a bank, they don't fall under the heavy regulations that a bank falls under, so they can give you a little bit better terms in order to attract better quality of a borrower in those markets. The problem with private credit is the problem with all credit. All credit is somewhat overvalued or fully valued, very tight spreads. You're right. Corporate bonds are, you know, if you look at investment grade bonds, they're near 27-year narrows and how tight those spreads are. High yield bonds are near some of the tightest levels we've seen, you know, since 2007. Bank loans are a little bit more attractive and private credit is a little bit more attractive, but they're not cheap by any stretch of the imagination. If you were looking for something cheap in the bond market, you'd probably be looking more like mortgages, maybe international bonds, emerging market bonds, and the like. There's probably better deals there. Doesn't mean they're bad. It's just that there's more to that market. And also, from an investor standpoint, a public investor standpoint, very limited opportunities right now. The private credit ETFs have only just started rolling out, and there's only a handful of them right now, and they're, you know, in their beginnings, right, to start with.
Jim, you described the formation of your credit ETFs and how you were able to encompass the 18,000 plus securities in the universe with just, you know, with a handful of underlying ETFs, of underlying managers. Compare and contrast, you know, the access and the ease versus going and picking bonds and, you know, dealing with desks.
Yeah, so we have an ETF with Wisdom Tree, WTBN, which is, that's its symbol, WTBN. It's the Wisdom Tree Bianco fund, and it is a total return fixed income fund. Now, we manage it via an index, and when we decide, we look at the market and we decide, where do we want to be on credit? Where do we want to be on mortgage-backed securities? Where do we want to be on duration? That would be our interest rate bet. What kind of out-of-index bets do we want to have, which right now we have one in senior bank loans. We could do one of two things. We could either buy the underlying securities, or we could buy baskets of those underlying securities in buying other fixed income ETFs. Now, as a contrast, there's the largest ETF in the world is the Vanguard Total Bond Index, BND. It owns 18,071 securities as of December 31st. Our fund, WTBN, which we've weighted through 14 ETFs, we looked through and said, how many unique securities are made up of those 14 ETFs? And it's 18,072. It's actually one more than the Vanguard fund. We didn't plan it that way. It just turned out to be that way. But when you look at the cost, the slippage, the transparency, and even the tax consequences of trying to acquire 18,000 securities, or saying, I can buy these certain baskets called fixed income ETFs, weight them the way I want, and make it much more efficient and transparent with a lot more liquidity in buying the ETFs. The Financial Times in July wrote a story called the ETF is eating the bond market. And more managers are starting to realize that these baskets of fixed income securities and fixed income ETFs are the way to go. And that's the way that we've done it too with our fund, WTBN.
I think it's really interesting when you go to Jim's world that he outlined, the 4, 5, 6-ish kind of world, and the you're getting 4 from the Fed. I mean, for sure, the best place over the last 3, 4 years has been to be as short duration as possible. But now people have mistimed when they wanted to add duration. They saw the Fed cutting, they started reaching out for duration. They lost a lot. The 10-year went from 3.5 to 4.5. Where do you go as you get towards this 5% type yield? You got to be more nimble. And so Jim is among the best macro people I've ever watched, if not the best. And so you look at how do you want to navigate the uncertainty of the bond market? And he's making changes on a monthly basis. And, using the ETFs, it's a very, very effective way to do that type of shift as the ETF of ETFs. And so we're excited to be partnered with Jim on this, and we're licensing that index. And for this 5% world, you want to protect the yield. If the yields are creeping higher, you have Jim helping manage what are the exposures you want, and sometimes be overweight duration, underweight duration, making these credit tilts be great to watch him make these tilts every month.
I want to emphasize that point that Jeremy was trying to make. If you own 18,000 securities now, bear in mind BND is an index, so it's not going to change that much. But if you're actively managed and you say, okay, we need to shift focus, we need to sell 3,000 securities and buy 3,000 different securities, it's tough, and it will take a long time to do it. And this makes it a lot more efficient.
Impossible to touch on rates without touching on the dollar. And we've seen some dollar strength here, maybe overly so. Where do you guys see the dollar ending up this year? And is there a certain kind of crunch point where like too strong of a dollar is going to be just kind of chaos for many players?
There's no question the dollar is very much tied to interest rates. And when you look at the correlations, the 10-year move very much correlates with the dollar. So today, as the 10-year spikes 10 basis points, what was stronger? The yen was very weak. The dollar is very strong versus the yen, but also just the basket of the dollar was up. I think from an international equities perspective, most people have loved to bet on the dollar declining forever. And, they often say they have no idea where the currencies are going to go, yet they're persistently short the dollar. And my worldview is that most people have no idea where the currencies are going, and they shouldn't be betting on it. It adds to volatility, not expected return. You know why you get paid to own stocks, the equity risk premium. We're talking about that 7% real return. What's the real return for owning the euro? I think it's a bet. Sometimes the bet pays off, sometimes not. There's all sorts of theories on inflation and interest rates and all purchasing power parity, but it's a bet at the end of the day. And half the time it pays off and half the time it doesn't. So I think the dollar adds more diversification to a portfolio than the reverse. I know the dollar is expensive on a purchasing power parity basis, but if the interest rates go higher, I think the dollar is going higher. The currency can stay expensive for a very long time. And I think right now it's all being driven by rates. And I think the risk to equities is rates going higher, and the dollar is going to go higher with it.
Most of our clientele is in Latin America. Are there any LATAM currencies that you guys are more fond of?
Well, it's interesting. We actually have a basket. So we have two currency. We have a whole suite of currency hedged ETFs. We have some that dynamically hedge, some that are fully hedged. We have two raw currency funds. One is USDU. It's a broad exposure to the dollar, tracks the Bloomberg Dollar Index. We also have one that's emerging market currency, CEW, and that is a 14, 15 country basket, equally weighted. You get nice yield pickup when you go to EM, and sort of the yin and yang of when the dollar is weakening, that's the one you want to buy. From a country perspective, we have a model that likes certain countries, sort of long-term from all the geopolitical shifts. We like Argentina. We like Mexico. We like Poland. We think they are benefiting from some of the different supply chain dynamics with Russia, Ukraine. Poland's been one of the big winners. We think Mexico's going to win. We like India long-term. They've got some challenges from a currency perspective recently, but from a long-term perspective, we like those countries as long-term winners.
I would add to that, you're talking about Latin American countries, that what Milei is doing in Argentina is probably the most important economic story in the world right now. And the success that he's been having and the continued success that hopefully he does have. and that everybody from President Trump on down through Wall Street has been paying very, very close attention to what he's been able to do in the last 18 months in Argentina. And so that has really been a very important story to watch.
Indeed. So in 18 months, he's accomplished a ton. And then let's turn our attention to our man Trump. In 3 weeks, there's been a lot, at least a lot said, and let's see what the carry through is. The Mar-a-Lago Accord and, you know, some key need to knows.
Yeah, so historically, whenever there's been a major currency accord, Bretton Woods, the Plaza Agreement, it's usually named after the place that they held it at, the resort they held it at. So the Mar-a-Lago Accord is an idea. It's not an actual thing yet. Maybe, maybe never. And the idea is the plan that is to maybe weaken the dollar and take care of the debt situation in the United States. It was authored by Stephen Mirren, who was at Hudson Bay Capital and is now Trump's Council of Economic Advisors nominee. Has 3 parts. Part 1, we all know, that's tariffs. To use tariffs is either a source of revenue, as Trump affectionately calls it, he's going to start the External Revenue Service for tariffs, or to use tariffs as a club to get other countries to do what they want. Witness what he did with Mexico, and then he pulled the tariffs and they put 10,000 troops on the border, or at least they said they would put 10,000 troops on the border. The second part, we already know too, they've already announced the formation of a sovereign wealth fund. Treasury Secretary Besson was asked, where's the money going to come from for a sovereign wealth fund? And he said, we're going to monetize the assets that we already have. And everybody looked at themselves and said, well, what exactly does that mean? Well, that was laid out too, is that we would take assets that we've undervalued. And the great example of that is the United States owns 8,000 tons of gold between Fort Knox and the basement of the New York Fed. It's valued at $42. The current price of gold is $2,900. So if you take those 8,000 tons, value it at $2,900, there's $1 trillion for you right there. And then you can use, revalue other assets like land, monuments, and the like, and then maybe even borrow against them to buy some other assets. Now, why would you do that? Because if you've got too much debt, you can get rid of the debt, or you could pump up the value of your equity so your debt to equity ratio looks a little bit lower. And the third part is fairly controversial, which hasn't gotten talked about a lot. That is the idea that the U.S. has been the world's policeman for 80 years. A lot of the $36 trillion of debt that we've acquired has been through the use of the military and keeping the world order since the end of World War II. Trump has been very vocal at the idea that we've gotten a bad deal and that there's been too many free riders in NATO and in Europe. He already gave a speech to Davos in his 3rd day of his presidency, where he said that these countries, he will demand that they pay 5% of GDP in defense. Remember, they've got the Maastricht Agreement that they can only run 2% deficits. So he's saying, and they're already spending a little less than 2% as a group on defense right now. So that's a big ask of those countries. And it might not stop there. In the Besson paper about reorienting global trade, the Mar-a-Lago Accord was this idea that Trump would demand for a continued security agreement. Look, we will continue to be the Navy, patrolling the world's waters, but you've got to pay, and here's how you're going to pay. You're going to take your trillions of dollars of Treasury securities that you own right now, and you're going to swap them for a 100-year zero coupon bond, which has about a fair value of about 13 cents right now. That would dramatically reduce the amount of debt outstanding by the United States, add in the equity that we've added up, and that would really solve the problem. Now, the last thought is, why would Europe do that? Because Trump would say, like he did on the campaign trail, if you don't do it, we're not going to come to your defense if Russia, North Korea, China, or Iran start making trouble. So he's saying you've got to start to pay. And again, this is not the policy. This is an idea, but we've seen parts of this start to come. And I leave you with the idea here. They're thinking big. And why are they thinking big? Because we've got a big debt problem, and big debt problems require bold, brash thinking. And that's the way they are. Now, maybe none of this comes to fruition, but that's the way they're thinking right now.
Incredible. Let's talk about liquidity and different ways to see it. There's some forces that are kind of balancing each other out in a way. Is it net still positive liquidity, still risk on animal spirits? Or are we seeing some money coming out of the system?
I mean, one of the ways you heard it a little bit from Powell today, and it ties into the inflation story. One of the things that we're happy about, you know, the money supply has been we think a key long-term driver of inflation. There was a headline that I saw yesterday that Powell admitted, this might be the first time he's admitted this, that money supply, that a surge in the money supply might cause inflation. Did you see that headline? We've been saying that since 2020, May of 2020. Siegel's been saying the money supply surge was going to cause inflation. The Fed had not said that. The Fed had said there, you know, the small minutiae, they didn't see the relationship. It was the first time I heard Powell say it. But why I say that is we were concerned maybe, you know, 12 months ago, the money supply was declining. You know, you want this money supply growing 5% a year, which correlates to 2 to 3% real GDP plus 2 to 3% inflation. That gets you a 5% growth in money supply. That was negative. We thought that was a sign the Fed was too tight. It's starting to grow again. It's not growing at 5%, but it's growing more reasonably. And, you know, that's more signs of a healthy economy. So that's, I think, the positive backdrop. That's my general take on that.
Yeah, I think that on the negative side, on liquidity, what we're seeing too is that in the treasury market, because that's usually when people talk about liquidity, they kind of focus on that. There's, you know, some tools that the Fed has put together over the last several years to help augment or try to manage liquidity. One of them is the reverse repo facility, or the RRP as it's known. And the reverse repo facility was a tool to sop up excess liquidity. So when there's money in the reverse repo facility, it is money that has been removed from the financial system, and it takes away from liquidity. When the reverse repo facility falls, it's money being reintroduced back into the financial system. Well, 2 years ago, the reverse repo facility had $2.3 trillion in it. Today, it has about $100 billion in it. So that means that a lot of that liquidity has been reintroduced back into the financial system. It's already back in. How much more is left to be reintroduced? 100 billion. That's not a lot. What happens if after that 100 billion has gone in and we still need more liquidity? There isn't that reserve on the sideline to keep coming in. So there's been some concern that the liquidity situation in the markets might become a problem. Now, concern might, it's not now. There's scenarios where you can outline it, that it can be a problem, but I would argue that even if it is a problem, it's something that we're acutely aware of. The worst kind of liquidity problems are the ones that jump up out of the blue and you didn't expect them. This one wouldn't necessarily be out of the blue. Doesn't mean that it won't create indigestion. It probably would if we had a liquidity problem. But yet there is that warning flag right out there that the amount of potential liquidity to reintroduce is getting very low.
At the global level, you guys are favorable on Japan for valuation reasons. What other markets should we look at from an equity perspective?
Yeah, that's so I look at our flagship ETF is DXJ. It's got a 12.5 PE, so close to an 8% earnings yield. When you hedge the currency like we do in that, you get paid 4%. And so I think about that, not when we first talked about US equity returns, 6.5 to 7% nominal returns. In Japan with DXJ, you get paid 4 off the bat from the hedge, from the carry off the hedge. The dividends are 2.5 to 3. They're doing at least 1% net buybacks. So I think without any price appreciation, I think you're getting 7 to 8%. So I think DXJ can outperform the S&P just on the carry and the dividends with no price appreciation. If you get any positive valuation sentiment, their earnings grow over time. You know, any inflection there, it could beat by a number of points. So maybe like 10 to 11% versus 7% for the S&P. So that's my favorite market. I think, you know, from a strategic long-term perspective, I'm not bullish China. I know China's had a huge stretch the last few weeks. Last year, it's actually done okay. I think China's conflict with the US will be longer lasting. I think Trump's challenges with China are not easy to solve. There's even just today, there's headlines that we're negotiating closer with Putin to end Russia-Ukraine. That could be very helpful to Europe. Europe's actually performed. The DAX has been actually outperforming the S&P. Europe could become back in focus if there's a resurgence, a reinvestment, rebuilding of Ukraine, that conflict gets behind us. Let's see the final details. I'd be more optimistic on Europe turning the corner than China long run. But China, it's got its own set of challenges. And from a long-term perspective, we much prefer India if you're talking decades. But if you're talking, just the short term, even, India and Japan versus China are two plays in Asia.
You try to get Q with it and go small cap in Japan, or just play the broad market?
Well, certainly that's where, if you look at some of the news flow, there's a lot of activism coming, and there was a movement by the Tokyo Stock Exchange. If you have a price to book ratio below 1, you had to take some kind of actions, and you're starting to see buyout offers, 50%, 70% premiums to their current prices, and still being below 1 times price to book. So you're seeing some aggressive action in some of those small caps. Obviously, it's more fringe, but so there's place for that. We have some exposure to both small caps and large caps, but I think the mainstream is DXJ with the large caps.
Can I ask you a question, Jeremy?
Yes.
How about Europe? Because there's very cheap valuations in Europe.
So the broad number is something like 10 PE for a lot of the exporters, but you get 2 to 3 PE car companies. So it's like, Tesla's 115 PE, and it's, well, a bet on self-driving, a bet on humanoid robots taking over, whereas you've got these car companies with the threat of China, threat of Tesla. But, you don't, with a 10% earnings yield, you don't need a lot of growth. You just need the earnings to not decline. So I think there is a lot baked into it. You don't have to have great companies. It just needs to be that the earnings don't decline. And so I do think long-term, it could surprise people. I do.
Mm-hmm. Well, gentlemen, coming up on our 30 minutes of allocated time, we could clearly go for much longer. I'm going to leave you with the last words. Anything that we are not paying attention to as a firm, as a group of investors, what are we whistling past the graveyard with?
I guess I'll start. I don't know if I would definitely say whistling past the graveyard, but I will emphasize a message that we were talking about, that the returns in markets the last couple of years have been very good. 20% in stocks, 25% in gold. Bitcoin has doubled. That was last year. There is a complacency among people that, well, that's kind of what they do. And what we're trying to say is not that they're going to be bad, but that they're going to kind of mean revert, and we're going to see mid-single digits kind of returns in markets, and that you need to adjust your expectations for that. There are opportunities. We've been talking about, whether or not it's India or it's Japan or it's active fixed income, but there's opportunities to augment the returns in that kind of environment. But if the answer is, no, I'm just going to own a broad-based index and wait for the gale to push the market up another 20%, because it has in the past, you might be disappointed as we go forward in the future.
Get off the recency bias.
Mm-hmm.
My closing thought, I think you've got Jim for navigating the complexities of the bond market. That WTBN, I think, is a great core bond fund to navigate all these uncertainties. I think for, where can you really improve, and where are people complacent and lazy? A lot of people leave too much money in the bank earning nothing. The bank's paying you 0 when money markets are paying you 4% or more. So I think that is one thing, that if you haven't put your cash to work in banking accounts earning 0, it's work to do to figure out how you manage all that. But I think that's also where new solutions are coming, new technologies are coming. We're building them through blockchain-based services. But I think there's a lot of new features that Jim used to talk about, the bank walk after SVB. people don't walk fast enough.
Right.
They still walk back to the bank. And I think, if you have a lot in zero, you should figure out how to put it to work because you can get 4%.
I would emphasize that if you're wondering what you should do with your money, the first thing is, are you getting zero? And how hard is it to basically check out if your bank has a money market fund, which most big banks do, move your money into the money market fund. There, you can get 4% now with just, a couple of taps on your phone in 10 minutes of your time. And it's very little risk. That's the first thing everybody should be thinking about doing.
Awesome. Guys, you've been incredible. Thank you for your partnership. Thank you for your time. This was great.
Thank you. Thanks, Alejandro.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosure